Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And thank you very much to Campbell for filling in for me over the last couple of weeks for the Q&A episode. Much appreciated, and also good, I guess, for people to enjoy a different perspective from someone that can, as Campbell reminds me often, someone that's materially younger than I, so they might have a different outlook. So it's always good to, I think, have that different perspective. But thanks so much, and good to be back with you this year. Happy New Year to everyone that's listening, I guess, and everyone that's not. I hope we have a fantastic year on the podcast. I'm sure we will. There's plenty of questions to get through and plenty of blogs to write. Campbell's got a really interesting one coming up at the beginning of February. It's a really good topic, so we wanted to wait until kind of everyone's back at work, back in the swing of things before we publish that one. But we'll look forward to sharing heaps of content. And over the break, I've written a new book. I'll tell you more about that in the coming weeks. It'll be published about sort of mid this year. So, that was something to do over the break. And I've got another one. I'm going to write a second one in the next couple of months as well. So anyway, plenty to share with you, and hopefully we all continue to learn and grow. Okay, so let's get into this week's Q&A. And I will start. I'm not going to share the names, mainly because people want to maintain privacy. But I'm going to paraphrase, their question because it's a bit long. Essentially, they're 52 and 54, working overseas in a tax-free country. I'm going to guess Dubai or something like that. Could be something different. And they'll return to Australia in 2027, so next year, with around 700,000 of cash in savings, plus they've got 200,000 in ETFs. So, by that stage, they're going to be 54, 56, maybe plus or minus. And they've got about 1.5 million in super. So, they've got to bridge that period between being able to access super at 60 and retiring, which is kind of what they want to do, is early retirement when they return home. In terms of, so really that's 2.4 million of investment assets as of today, but they've also got a couple of properties, a townhouse. It's worth 950 with about 275 worth of debt. So let's call it about 600,000 of equity. So that brings us up to investment assets of 3 million. And then they've got a riverside apartment that's worth about 900. No mention of debt against that one, but they're going to use that as a potential downsizer. So I'm going to ignore that. Well, maybe I won't ignore it. Maybe I'll say they've got between 3 and 3.9, let's say $3 to $4 million of investment assets today. And they want to spend $160,000 a year on general living expenses. And what they're weighing up is that because when they return home, they're not going to have any borrowing capacity, of course, because their jobs that, they won't have a job and they won't be able to access super. So they can't go to the bank and say, because sometimes even you access super, you can say, okay, I'm drawing this pension from super, and that will still give you some borrowing capacity. There's a bit of extra information the bank will need in terms of exit strategy and so forth. But that sometimes, the super income stream can kind of replace to some extent the PAYG or salary income or business income, whatever. But in their situation, when they're pre-60, they won't have either of that. So they have no borrowing capacity. And what they'd like to do is buy a property down the coast. And they could rent it out initially, but they could use it potentially in retirement. And they feel like we've got this window of opportunity where we've got some borrowing capacity before we return back to Australia next year. And should we utilize that borrowing capacity? And it's a really interesting question. It comes back to really financial planning, of course. I know that's sort of an obvious statement, but you've got to be really careful about the decisions that you make and identify which are the big decisions. And I reckon that there's only probably over someone's lifetime a handful of decisions, 5 to 7 really key decisions. Where do I buy a house? If I'm going to invest in property, which property do I buy? These sorts of decisions that are really key and critical, and you just need to nail those decisions and then not make too many mistakes along the way, and you're probably going to do pretty well in terms of building wealth. So what are the considerations here? Well, if they go and buy down the beach, they're going to need to borrow about $1.3 million. So it's a substantial amount of borrowings at a time when they want to enter into a period that gives them more flexibility. And remember, the more borrowings you have, the less flexibility you have, because the more sensitive you are to interest rates and the more capital will be eaten away by interest expense, I should say. And again, at a time where, when you go into retirement, you want your property portfolio to be paying for itself. It doesn't necessarily need to throw off a lot of income necessarily, but you don't want it to be taking a lot of income out of your pocket at that time. So therefore you minimize the amount of capital you're eating to when you first then enter into retirement, because of course, if you spend more capital in the first 10 years of retirement, it has a large compounding impact. So that's one thing that people really need to think about, is that for anyone that, wants to have some flexibility in the next 5 years to either reduce working hours, and especially if you want to stop working in completely, it's probably not the right time to borrow. That borrowing will actually get you further away from that goal rather than closer to it. Now, with respect to these people, they're going to return, as I said, next year to Australia, and they will be able to access super in 2033. I think that's what they've said. So it's really that gap between 2027 and 2033 that they need to bridge or fund, which is kind of 6 years. If they were to go and buy this property down the beach, and the thing actually, before I get there, the thing that I tend to think about, especially personally when I've made a property acquisition, and property acquisitions are always, or tend to always be sizable. You're borrowing a lot of money. In this instance, $1.3 million. It's not small. What I've tended to do is say to myself, well, if I buy well, as in buy a property that has some uniqueness, strong land value component, good location. And if I pay fair value, or hopefully even if I'm able to get into a market that's kind of unloved and I can pay below fair market value, then worst case scenario is if it all doesn't work out, in 3, 4, 5, 6 years' time, I can sell the asset. And as long as I don't walk away without losing money, I don't necessarily need to make money, then it's not such a risky decision, because I can exit from that decision. As long as I can last that 3, 4, 5 year period comfortably, and as long as, I'm not going to crystallize any material loss, then the decision isn't, massively risky. I guess the issue is the location that these people are looking at buying that coastal property is pretty buoyant at the moment. And that would concern me, is that, are you buying maybe not at the top end of the market, but, and if they were young, younger in their 30s, who cares, because in 30, 40 years time, it's not going to really matter, the entry point. But as you get closer to retirement, you become more sensitive around these issues. So that's the first thing, is you've got an exit strategy there, or at least make friends with the exit strategy. Mate, say, worst case scenario is I buy this property, it doesn't work out for me, I sell it in 4 years time. As long as I don't lose any money, if I have a high level of confidence I'm not going to lose money, then you can always give it a go. But I don't think it's the right time for these people, even though they've got today, let's call it $3 to $4 million of investment assets. They're going to spend $160,000. I don't need to spreadsheet this, but the best thing would be to model it out. But I know $160,000 is a pretty significant draw on capital, and you've got sequence of return risk. Particularly, there's not much risk present in the market. There's a lot of risk present in the market, particularly share market. It's at all-time highs, and you've got the US doing some questionable things that could blow it all up. So I would say that, the market is relatively risky at the moment. And so your sequence of returns risk is that you get a lot of negative returns in the early years. So for example, if the market crashed 30% after 2027, and then these people needed to draw $160,000, you're drawing $160,000 off for a much lower base. And so that's your risk, is sequence of returns risk. And so to draw 160,000, even though they've got 3 to 4 million of investment assets, I wouldn't feel comfortable. I haven't done the numbers in terms of spreadsheets, but from my experience, I would say, no, I don't think buying a $1.3 million property, or borrowing 1.3 to buy a property, is the right stage of life. I think it's too risky, and, I think it could work out, but equally it might not work out. And the sequence of return risk is pretty high, especially as we've got, $1.5 million in super. That's obviously invested in the share market. Well, actually we've got 1.7 because we've got some ETFs. 700's in cash, so it's not going to earn that much. It's not a growth investment. So that's what I'd be worried about. Here's the proviso. I would say to them that if you're going to return in 2027, if you think you can do some part-time work and maybe earn $50,000, let's say $50,000 each. And that might be, contract work for 3 months and then have 3 months off, or it could be, just part-time sort of job. But for example, if you could defray some of that earlier cost in terms of needing to eat into your capital, your investment capital. So if you need 160 grand, if you can go earn $50,000 each, and so you're maybe only drawing $60, $70, $80,000, your net of taxes and all that sort of stuff from your asset pool, then I would probably say that might be doable. as in buying the property, going and spending that money and buying the property. And I appreciate, you could probably make it work in a spreadsheet. Like, this is the thing with numbers, is you can kind of make it work. You can convince yourself around some assumptions and what might happen to interest rates and what returns might be and all those sorts of things. But this is where I guess the nuance comes into it and the experience. And so people might sit back and go, "Oh, that seems a bit conservative, Stuart." But I don't think it is. I think that's really the way I would approach this. So I guess it's a case of sort of saying, yes, you can have it, but what are you going to give up? And what you're going to give up is, maybe more of a staged transition into retirement rather than complete retirement in 2027. Anyway, they're the things that I'd be thinking about. And just, for people that are listening that are kind of approaching that sort of window of making decisions, 5 or 6 years out from retirement, they're some of the things that I think about. Okay, next question is from Slav. Slav thanks me for the podcast, so thanks very much, Slav, for listening in. Long-term listener, so that's great. And he's asked me a question about what's called the Bendel case. And there's been some articles in the Australian Financial Review over the course of 2025, and there probably will be over 2026 as well, because it's a big tax case. Anyway, Slav's asked me to sort of explain it to him in simple terms. And, I hope not to lose you here, and I'll try and make it as simple as possible, but it is it's a complex part of the tax legislation. And there's another element that sort of relates broadly to the Bendel case, and that is that what's called Section 100A. And it all relates to using a family trust, right? Because obviously, one of the benefits of having wealth inside a family trust is that you've got discretion over where we distribute taxable income. And that could be interest income, it could be dividend income with imputation credits, it could be different types of income, it could be capital gains. And so we might give all the capital gains to the individual that has some carried forward capital losses, for example. And then we might give all the franked income to someone on a very low or zero taxable income to benefit from the imputation credits. So it gives us a lot of discretion and planning. And rather than owning assets, say, in one person's name, they're going to wear all the tax costs or tax consequences for the period they own those properties or assets or investments, ETFs, whatever they might be. So that's why we use a family trust. But the issue then is, for a lot of people, when they do have taxable income that a family trust earns, what do we do with that income? And particularly if we're in a situation where we've got minors as children, so people under 18, you only can give them $416, big deal. And if both spouses, for example, are on the top marginal tax rate and they don't have anyone else to distribute to, you sort of go, well, what's the point of having a trust? And so I've spoken before and done episodes on having a corporate beneficiary, which means the company is a beneficiary. That's really good because you can distribute into a company and max your tax rate at 30%, which is much better than paying 47%. And you always get a credit for the tax paid. So in the future, when you're retired, you can pay a dividend to that company and you'll get a credit for the tax that's paid. And that's really worthwhile. There's a couple of provisions here. With respect to using a family trust, more now than ever, it's really important to distribute the actual income. So in the past, for example, if I've got two sons, they're 19, they've got part-time jobs, but then they don't have a lot of taxable income, I could distribute through my family trust to them. If they live with their mum, my ex-wife, so I'm not paying living expenses for them, I'm paying some, but not many. So I would actually need to distribute the money. So I'm going to distribute $20,000 to one. I actually have to transfer that $20,000 to them. That's what's called Section 100A. Now, if they were sort of living full-time under my roof, I could say, well, the $20,000 goes towards paying their living expenses, and I could justify it that way. So you've got to be really careful about when you make distributions on paper. If those distributions aren't actually made, you need to speak to your accountant to work out, do we have a Section 100A issue? And there's some ways to deal with this. But for example, what they're trying to do is close the gap between, say, having a family trust and then distributing to, say, an uncle that has zero taxable income and doesn't have any Centrelink benefits or anything like that, but the uncle never knows about the distribution and never sees the money. Section 100A is attacking that sort of situation. So they're trying to stop people using family trusts as aggressively as they might have done. The Bandel case relates to a situation where a trust has made a distribution but hasn't person actually paid the cash. So that's called an unpaid present entitlement, which means a present entitlement means we've made the distribution election, but it's unpaid. So for example, the Bendell case relates to if I've got $100,000 of taxable income in my family trust, I say I'm going to distribute that to my corporate beneficiary, but I never actually pay the money. And that's called unpresent paid entitlement. The ATO has said if you don't actually pay the money, you've got to put a Div 7A loan agreement in place and charge interest. The Bandel case says no, you don't have to. That's outside the legislation. And I can't remember the exact status, but the ATO lost. The ATO appealed. They lost that appeal. And I think the ATO now has one more chance to take it maybe it's got to go to the High Court, I think. So there's one more step that they can take to try and overturn this decision. But if they don't overturn the decision, then potentially you can just leave all these distributions as unpaid present entitlements and, potentially use as a tax planning opportunity. The issue though, and you've got to be careful around these sorts of things, and you've got to be careful around, there's some advisors that will be really aggressive in order to generate fees and say, look, we've got this tax strategy that's going to save you a lot of money. Just be careful around those sorts of things. In reality, what's going to happen is if the ATO loses its last appeal, they'll just tap the government on the shoulder and they'll change the legislation. I'm sure of it. Like, they're going to close this gap, right? So we're not doing anything about the Bendell case at this stage for our clients. There is, you could argue there's an aggressive tax planning opportunity here in terms of leave it as an unpaid present entitlement for the 25 financial year, for instance, but I think that's a little bit too aggressive. The point is, I think the general rule here for people that have a family trust is if you're making distributions and those distributions aren't going in as cash. So if I'm distributing into my corporate beneficiary, but I'm not actually moving the cash in there and investing it within that company, that's the kind of trigger event that you need to talk to your accountant about and have a clear understanding of what are the implications of not actually paying the cash to the beneficiaries. So anyway, hopefully that explains it, Slav, but it's a really interesting case that's going on at the moment, and it's interesting that the ATO's kind of lost its case. Okay, next question is from Sandra. I'm not sure it should have ended up here, actually. Sandra writes, I find your podcast extremely interesting. Can you provide me with financial advice? If so, what information do you need? What are your fees? I'm 59 years old, live in Perth, been made redundant from an office manager role in a small construction company in December 25, so that's done. I'm in a de facto relationship and my partner is deciding to retire and move to Bali for cheaper living. I'm uncertain on my future in my relationship and if I should retire or keep working. So Sandra, thanks for your reply. Of course, in this podcast, always it's information only, never personal advice. So please, I answer these questions based on the information you've provided me, but that might not be all the knowledge that I need or information. There might be extenuating circumstances. So please never act on what I'm saying. It's general advice only. And Sandra, the reason I decided to read out this question that you submitted, just to deal with the issue of one-off advice, because it's probably, and I don't know enough about your situation, but it's possible that you don't need ongoing financial advice, you just need once-off advice. And I just want to talk about that for a second because it can be challenging and more financial planners aren't offering one-off advice. Now, I think with technology and AI and so forth, not as a replacement to the advice, but as tools to produce advice more efficiently, maybe that'll change. In fact, it probably will change in the future, which is great. I think it's great because we want to be able to provide once-off advice. But the challenge is that there's just so much compliance and risk around it. It's almost not worth doing. The other thing too that people should kind of appreciate is that one-off advice isn't that rewarding from a personal perspective. At least I don't find it that rewarding, because one of the benefits of working with a client is you get to know them and you get to enjoy the journey with them. And obviously I've been doing this for nearly 25 years, so I've had clients for that length of time, so I can go back and we started with nothing and look what we've got today. And of course we don't take all the credit for that, but at least we've enjoyed that journey and we can see the fruits of the labor and the outcomes of good advice and good investment decisions, and that's very enjoyable. Whereas you give someone one-off advice and you never know how it turns out. I mean, you get a sense that, once if you solved the problem, that's rewarding too, but it can be challenging. That just means for everyone listening out there, to find one-off advice is really challenging, but hopefully that changes in the future. Sandra, I can't help you, of course, in this format, but good luck with everything. Okay, next question is from Ken. He's 36, runs his own business, normally draws 250,000 a year in terms of profits, but business declined a little bit. That'll go down to 85,000. Two kids, 3 and 5 months old, 3 years and 5 months old. Wife's on maternity leave until 2027. Has done a land banking deal and should be getting roughly 1.2 million next year. So that sounds like a really good deal. 4 investment properties, Point Cook in Melbourne, one in Townsville, one in Logan, one in North Adelaide, and then owns 2 more properties with his brother 50-50, one in South Australia and one in Geelong. Each property is worth roughly 700,000, so the total portfolio is worth 4.2 with 2 million of debt, 300 in super for him and 30 for his wife. And his goal is to replace his wife's income, 40,000, and then the ability to travel each year, spend about $20,000 doing that. Still happy to rent, so obviously he's rent investing. Would like to buy the dream house in 10 years' time when our kids are about to go to high school. Appreciate thoughts on our situation. So, 36, done pretty well with respect to property investing. About 1.5 million in equity in the property portfolio. And then if there's 1.2 million coming from the land banking, I don't know if that's after CGT or any tax associated with it, but let's call it, let's just say it's $1 million. So let's say 2.5 million net investment assets at 36. That's a really good start, of course. That's a fantastic start. Of course, then you add super on top of that. So let's call it 2.8 or something around that mark. I've spoken about this many, 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 many times. The thing about buying a home, your sort of future forever home, a dream home in 10 years' time, is that it's going to suck a lot of equity out of the investment assets. So if we've got, let's just use round numbers. If we've got 2.5 million of net investment assets today, what is that property going to cost you? I don't know the answer to that, but let's say it's worth 1.5. That eats into, a substantial proportion of the net worth that you've allocated now. The other thing then you've got to realize is, well, you've got to pay for that property at some point, in 10 years' time. How are you going to do that? Well, you might have to sell some assets. That's going to crystallize capital gains tax. So you actually then need even more money. And after capital gains tax, maybe the 2.5 million is less than 2. If that's the case, then, and you spend 1.5, you've only got $500,000 of investment assets. So as you can kind of see, a delayed home purchase, and the longer you delay it, because the more, typically forever home tends to be in an attractive location, and those locations will benefit from compounding capital growth. So it could cost you twice as much in 10 years from now. It could cost you circa 3 million, and it's going to rip a lot of equity out of your investment asset base. And for those reasons, as I've spoken many, many times before on the podcast, try and buy that asset now. So maybe what you could do is use some of that, or some or all of the equity you get from the land banking deal to buy the forever home today and put a tenant in it. If you're happy to keep rent investing, do that. The next observation I would make, especially in regards to the assets you have and the locations, just be careful. And I did a podcast on this late last year around extrapolating the last 5 years of growth and performance. You've got $1.5 million of equity in the property portfolio, so it's really difficult to tell you it's not going to work in the future, because your lived experience is it's worked really well over the last 5 years or however long you've been investing. But and so I acknowledge that it's like telling someone that's invested in Bitcoin 20 years ago that Bitcoin's crap and it's never going to work. They've probably made millions of dollars. That's their lived experience, right? So I'm acknowledging that. But the thing is, you need to then think about, the best frame decision you can make at this stage, if you want to get yourself into that position of being able to, retire early and so forth, is what decisions can I make when I'm 36 so that I look back when I'm 56, 20 years from now and go, wow, I nailed those decisions. That time horizon is the best approach, because it will really force you to focus on the fundamentals of the assets you're investing in. Whereas if we make decisions based on what can make me stronger by 2028, I'm then forced to really focus on shorter term indicators, things like sentiment and current interest rates and these sorts of things. So that's the thing that I'd be sort of focused on. So the question then would be, of the properties that I own, either 100% by myself or co-own with my brother, what is the strategy? How long will I hold these assets? Are they long-term holds? Do I still want to own them when I'm 56? If not, what is the exit strategy? So I'm not saying get rid of them tomorrow, but I'm just saying, okay, if we think they're in locations that have really had fantastic growth the last 5 years, how long will that growth cycle last for? And is it worthwhile exiting that market when I feel like the growth has reached a level that is unsustainable, or the values have reached a level that are unsustainable? Because we know those properties will go into flat cycles eventually. They're in locations that aren't prime. Their average growth over a very long period of time, will tend to be below the median. And remember, most properties and locations tend to start to drift towards the median value, but it's whether they've got the fundamentals to push the value well beyond the median, or then whether the growth starts to spread out geographically. So Ken, they're the things that I'd be thinking about in your situation. Buy the forever home as soon as possible. Have a good strategy around the properties that you've got. But you're off to a great start. It's really now just making sure that you manage those assets as well as possible. Okay, next question is from Mary and Evan. They met later in life, so their finances are relatively independent. Mary's 58, earning 130,000 a year, 580,000 in super. Q Super opened an account with ART just recently. Owns an investment property just outside of Noosa, worth around 1.2 with a $750,000 loan, so heaps of equity in that property. It bought it in 2020 for 650, so it's shot the lights out. Bought it just before the market took off, probably just before COVID, which is a fantastic situation. 150 grand in a colonial first state portfolio, adding $100 per month. Her partner, Evan, 64, is a self-employed builder, builds resi properties, draws $100,000 a year, 150,000 in super, only just started recently. The home's in Indooroopilly in Brisbane, 1.8, owned outright. There's an investment property in Brisbane, has 2 dwellings on it that Evan owns, no debt, 1,700 per week in rent, and inherited portfolio from Evan's mother, 1.3 million. Both aren't ready to retire but might sort of pull back in working hours and like to do a holiday, a trip overseas each year. And so Mary's questions are, should Mary sell the share portfolio and or the investment property and put it into super? Well, the thing that I'd be thinking about, Mary, is firstly how much unrealized capital gains is in the share portfolio. So how much tax are you going to pay in order to do that? If you are looking to reduce working hours in the future and you're going to go below that $130,000 tax bracket, then you might wait to sell the share portfolio then. But if it didn't have much in the way of capital gains tax, even if you sold it today, yes, I would. You could make a non-concessional contribution. The non-concessional contribution cap we will find out in the next few months, increase to 130,000 on 1 July. So you could almost get all of that in one foul swoop. In fact, what you could do is put 120 in June 2026 and then the rest in July 2026. So you can get it all in, or you could do the 120 now, of course. Certainly you say you're adding $100 a month into that portfolio. I would stop that. I would put that $100 a month into your super. I certainly wouldn't put it into the share portfolio. In terms of the investment property, well, that's a bigger asset, right? So that's certainly got a lot of capital gains tax. I probably, given it's so low level of gearing, I probably wouldn't move it into super because you've got the gearing there. You've had the gearing there at least. So it's going to get you a little bit of leverage, albeit not very much. And that market's still doing pretty well. I mean, the Sunshine Coast, I don't know how long it will continue for, but I think I would hang on to that asset for a little bit longer and potentially clean up the colonial first state portfolio and move that into super. Next question is, should I move from Q Super to ART? As in, ART is supposed to be doing a lot better than Q Super. Look, I can't give you that advice. Certainly, and I haven't looked at Q Super for a while. I know ART is doing very well and has done very well if you look at the sort of 10-year returns. So certainly it's an attractive fund. Its fees are a little bit higher than, say, Australian Super and these sorts of entities. Now, the returns that we look at are net of fees, net of investment fees. So you go, well, Stuart, they're still better off. That's true. But I guess it's whether that performance persists or outperformance persists. But I think it's certainly worth looking at potentially moving. Mary says, can I move $120,000 per year? No, that's actually a contribution limit. You can roll over super as much or as often as you like. There's no caps there. And if you're unsure, Mary, what you could potentially do, you've got 580,000, and if you move the colonial first state stuff in, you're going to have, something close to 700,000, of course. So you've got quite a bit of super. If you're unsure, maybe go 50-50 and leave 50% in Q Super and 50% ART. And that way you kind of spread what we used to call fund manager risk, which is super fund performance risk, I guess you could talk about it like that. The downside to having those two accounts is you're going to pay 2 admin fees, but it's like $70 a year or something. So it's not that big a deal, and it does spread your risk. So that's something you could think about. Next question was, what are the options for Evan with very little super? Okay, so this is a really interesting one because I'm going to make some assumptions here. The share portfolio that Evan inherited from his late mother, is mainly blue chips. It's worth $1.3 million. Here's Evan's problem. I'm going to imagine Evan's problem because all the portfolios I see will be like this. It's going to have a lot of unrealized capital gains. So I would not be surprised that he's probably got holdings like CBA, BHP, CSL, these sorts of businesses that listed, many decades ago. A lot of Australians bought the stocks when they were listed and hold them for a very long period of time. Hence, you end up with a really large portfolio. And a lot of those stocks have done really well, like CBA and CSL, of course, and BHP. And the problem, though, then is people are stuck with, I've got a portfolio worth 1.3, but the cost base is like 400 grand. And so if I went and sold it, I'm going to crystallize a $900,000 gross capital gain, and that's going to give rise to a lot of tax. And so then the challenge for a lot of people then is, I've got this portfolio, I want to move it into super, but I'm going to pay a lot of tax. And then I've got this portfolio that's heavily concentrated in just a few stocks, which isn't ideal. I'd like to have more diversification. I'd like to use ETFs, these sorts of things, but I'm going to have to deal with the capital gains tax as a consequence of that. And the issue was back when CBA was trading at $170 or over $170 a share, it's now circa around 150, is that with the conversations we were having with clients was, we think it's overvalued, you should sell some. Yes, you're going to pay capital gains tax, but actually the capital gains tax you pay now could be less than what the share devaluation was. We thought it was sort of maybe circa 30% overvalued at that level. So if you lost that 30%, there goes your capital gains tax bill, right? So part of it is not only just what tax do I pay, but the other part of the other side of the coin is, what could I potentially lose in value? So if we've got a highly concentrated portfolio and one of those stocks really falls significantly in value, instead of having a $1.3 million portfolio, you've got an $800,000 portfolio. So, this is the thing we've got to try and balance out, managing tax consequences as well as, trying to build a better portfolio. But of course, the opportunity for Evan is to try and gradually move that share portfolio into super. And I would be doing that if I was him. I would be strategically selling down any holdings that I thought were overvalued. So even though if you hold CBA, even though it's $150 today, I would probably still take some of that profit. I think even $150 a share, it's still probably overvalued. Maybe not as overvalued as it was at 170, but still overvalued. And so maybe what he could do is just make friends with, yes, I'm going to pay some tax along the way, but I'm going to notionally sell, let's say 100,000-ish, maybe up to 120,000 each year, make that non-concessional contribution into super. Of course, he can make concessional contributions as well to offset the gain. So he can make 30,000, and again, on 1 July, that concessional contribution cap will probably be indexed to 32,500. So at least he can make that tax deductible contribution to offset some of the capital gain. But if I was in Evan's shoes, that's what I'd be really thinking carefully about, is how can I gradually move that portfolio into super? Because of course, once he's in retirement phase, it's a tax-free environment, which means he's going to get the refunds on importation credits, these sorts of things. It's far more tax effective. So thank you, Mary and Evan. Thank you for those questions. There's always really good sort of insights in there. I've gone a little bit over today. Tomorrow, for my first blog in 2026, had to think about that, I'm going to talk about what my expectations for the property market are for this year. As I tend to do every January, I tend to do a podcast around that topic. And I will be appearing on the Australians Money Puzzle podcast today, the 20th of January. I think it might be actually published on Wednesday morning, so maybe the 21st, talking about that very topic as well. So until tomorrow, bye for now. Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.